Good evening, members and guests, and welcome to tonight's Get Set for Retirement webinar and Investments Update. It's fantastic that you could spend some time out of your evening with us tonight, finding out some of the things that have been happening at your superannuation fund. So I'm Kate Farrar. I'm the Chief Executive Officer of LGI Super and Energy Super. And with me tonight, we have the wonderful Fiona Mann, who is our Head of Listed Equities and Environmental, Social and Governance Investment. And we also have Kelly Barnes, who is our Fund Services Manager. Before I start tonight's webinar, I'd like to acknowledge the traditional owners of the land on which we are all gathered and pay my respects to their elders past, present and emerging. Tonight's presentation is designed to provide you with an update on both the fund itself and also importantly on our investments and investment markets. We're also going to be covering some key topics and key considerations around putting together a plan so that you can have your best possible retirement. I'm going to start off tonight and provide you with an update on our fund, including the progress of the Energy Super and LGI Super mergers, and our recent Suncorp acquisition. We're also going to be touching on some of the upcoming key events that may impact on you over the next 12 months and talk about what you can expect over that time as we integrate our funds and our brands. I'm then going to hand it over to Kelly, and she's going to take you through how much you may need to retire comfortably, a very important consideration. Then Fiona is going to talk to you about what's happening in investment markets, the general economic outlook, talk about some of the key aspects from the federal budget, and finally and importantly talk about our fund's investment approach. We'll then hand back to Kelly to cover off on how to build wealth, as well as understanding the age pension and how to get the help that you need to build a retirement plan. We expect that the presentation will last about an hour, and at the end there's going to be an interactive Q&A session. So having the interactive Q&A session is a very important part of what we do because we like our webinars to be really relevant. So at any point throughout the webinar you can lodge a question by clicking on the blue hand at the top left-hand of the corner of the screen. We'll go through as many questions as we can today, but please, if we don't get to your question, rest assured that we will be back in contact with you to answer it over the next couple of days, as long as we have your contact details. So before I hand over to Kelly, I'm going to quickly discuss the direction of the newly merged fund and provide you with an update on our acquisition, very recent acquisition of the Suncorp Super business. Before we go on, though, I'd like to advise you that the information that we are presenting is general information only, and it has been prepared without taking into account your individual objectives, financial situation or needs. You must not rely on the information alone as the sole or the primary source of advice and guidance for the purpose of making decisions about your superannuation options. But we do have lots of experts here who can help you if you need. Next slide, please. As I'm sure you're all aware, the 1st of July last year, we celebrated the completion of LGI Super's merger with Energy Super, which was really a major milestone for both of our funds. By completing that merger, we have created a strong super fund that at the end of February managed $24 billion in retirement savings on behalf of around 124,000 member accounts. Now, our board was very focused on the fact that we must continue to grow, but as we grow, we'll always retain our very unique member-centred approach and our commitment to customised investment experiences for every member as a truly boutique profit for member fund. We think that our size gives us a special advantage compared to the mega funds and allows us to respond to the distinctive superannuation needs of each one of our members. In this rapidly changing superannuation sector, and it is moving fast, we always want to remain really agile and responsive to ensure that we give you the best outcomes. Bringing our two funds together does just that. So it's been an exciting time since the 1st of July and a really busy time for everybody in the fund. We've all worked very hard. I think I'm very proud of how the team have delivered for you all. Some of the benefits that we have been able to provide to members since the merger include, first of all, from the 1st of July in 2021, all Energy Super pension members received a reduction in your direct administration fee, which reduced from 22 basis points down to 18 basis points per annum. We did communicate that to you prior to the merger, and that brings all of our pension members together under the same fee structure. In November of last year, we removed our weekly administration fee of $1 per week, $52 per year per account. This means that you're only being charged the annual percentage-based funds under administration fee that you were already paying. So that fee is 18 basis points of your account per year, capped at $900 per year, which is, again, a reduction for the LGI super members. We're now one of the very few superannuation funds that don't charge both a weekly and a monthly flat rate administration fee, as well as the percentage-based administration fee. So that's good news for members and a direct saving from the merger. From the 1st of February of this year, members are receiving a tax refund of 15% on the annual percentage-based administration fee. So as this fee is deducted from member investment returns, the tax refund will also be applied back into member investment returns. But after applying the tax refund, the net result for every member is a net administration fee of 15 basis points per annum, which is fantastic. We acknowledge that since the merger, members have seen an increase in the indirect cost ratio associated with investing your superannuation. This is related to the performance and costs incurred at each one of the individual fund managers, generally speaking, prior to the merger. Indirect costs are made up of things like brokerage, stamp duty and performance incentives, which are only paid when those managers perform. And they're not charged directly to your account, but are deducted from earnings, so there's no need to add anything further. I'm pleased to say that you will very shortly be receiving a communication from us confirming that these costs will be reducing for most investment options again into the future. So please keep an eye out for those communications to you. As a merged fund, we will continue to work really hard into the future to ensure that our investment returns support you building your best possible retirement, but are also delivered to you at an acceptable price point, which we know is very important. We're always looking for ways to be the best possible superannuation fund that we can be for you, our members. So it is for that reason that we've continued to explore opportunities to grow our super fund that ultimately resulted in our acquisition last week of the Suncorp superannuation business. We had previously communicated with you about that acquisition, and I'm very pleased to say that on Thursday we settled on that acquisition, and on Friday the 1st of April the Suncorp business in its entirety became a part of the broader LGI super group. The superannuation industry is consolidating really rapidly, with merger and acquisition activity driven by a need to lower costs and improve service offerings to remain competitive, and to ensure that we're always acting in the best interests of all members. So the acquisition of that business gives us the combined size and scale to deliver efficiently for all of our members while maintaining the personal and boutique member experience that you have all come to grow to love, and that sets us apart from the growing number of superannuation mega funds. As we've previously mentioned in some of our communications on the acquisition, LGI Super and Energy Super account holders can also be assured that the Suncorp transaction won't have a direct impact on your membership right now. As part of the agreement, Suncorp will continue to distribute superannuation products to Suncorp customers for a transition period of 18 months following the completion of the sale, essentially operating it as a standalone fund. In the future, however, the Suncorp Superannuation Fund will be merged into Energy Super and LGR Super funds to create a single sustainable $31 billion fund. In effect, for the Suncorp members, we're going to be mutualising that fund and placing the ownership of the fund into the hands of all of the members. And it's the same fund structure that we have at LGR Super and Energy Super, so everything is operated on the same basis. Once that is completed, we'll be an entity with greater scale, and therefore all members can expect to see reduced fees as integration benefits are realised, with enhanced products, services and personalised workplace support programs being some of the planned acquisition benefits. As part of a fund of that ideal level of scale, all members can expect to see some of these benefits as the integration develops, including an increased range of investment opportunities, strong and sustainable long-term returns, lower investment and administration fees, access to enhanced products and services, and greater access and presence, particularly in regional areas. As a $31 billion fund, we'll also have increased access to high-performing mid-market investments with a focus on the assets that build communities and support our members where they live and work. So a question I'm often asked as I meet with members is what we can expect from the fund over the next 12 months. So I said that we've been working hard, but our team continues to work really hard on a range of different services and product enhancements for you as always. But I did want to draw your attention to some of the ones that you can expect in the 2022 calendar year. So first of all, on branding. While LGR Super and Energy Super are both currently operating under our original brands, we're also really excited to be working on the rebranding of our combined fund. Our new brand is going to be formally launched over the next couple of months, and that will include a new name and logo that we hope will epitomise and pay homage to the two predecessor funds, but also recognise the exciting future of our combined sustainable and stronger fund, as well as the benefits that's going to deliver to members. The second item is our administration transition. So a key element of bringing together our two funds as part of the merger is consolidating all of our back office, administration and operational functions, including moving onto a single administration system. So that will allow us to reap some of the benefits of being a larger fund, but also make sure that all members experience exactly the same experience when transacting on their accounts. We're currently working towards this, and we expect that that will occur in September of this year. So while between now and that time, there will be limited impacts for you, as we approach the transition date, it will be expected that there will be a small period of time where transactions, payments, and the daily publishing of earnings rates will be paused to allow us to facilitate this change. So we'll be communicating with you before it happens and about what is going to happen, so there shouldn't be any surprises. Importantly, our services will all remain the same. So an essential element of our complete fund merger is the commitment to being a boutique superannuation fund. And a key part of being a boutique fund is continuing to offer our personalised and local member servicing. We're going to continue to have our team visiting all our key locations to meet with both retired members and working members in their workplaces. We'll also continue to hold our regular seminars and our webinars like this one to provide opportunities for our members to hear directly about the fund and how we invest our retirement savings. So we really do value our feedback. Don't forget about the questions, and please let us know. Just on the LGR Super mobile app, in February of this year, LGR Super launched our first ever mobile app, which is now available to download from the Apple and the Google app stores. The app was released obviously just to those members on the LGR Super brand who had not previously had access to an app. The LGR Super mobile app gives you an easy, convenient and secure way to manage your super. It's a great way to see how your super is tracking towards your future retirement goals, and it also gives you really quick access to update your account on Member Online, where you can make a lot of requests and updates if you need to. The app currently offered to Energy Super members later this year will be replaced by the LGR Super app, and we'll continue to communicate with you about that in the future. We're looking to provide members with the same and hopefully even more functionality than you enjoy now. If you're an LGR Super member and you haven't downloaded the app, please go now to the Apple or the Google Play stores. So that's it from me, and I'm now going to hand over to Kelly, who's going to take you through how much you may need to retire comfortably.
Thank you, Kate, and thank you everyone this evening for joining us. My name's Kelly Barnes. I'm a Fund Services Manager here at LGIA Super, and I'm really excited to run you through our Get Set for Retirement webinar tonight. Now, before we start, I do just want to outline that we are going to talk about a couple of different strategies tonight, and we are going to go through that at quite a high level. So if you do have any questions, or you do want to find out if this is in your best interest to do, or you'd like to find out if personally you need to do these types of strategies or should be doing these types of strategies, definitely recommend reaching out to us and speaking to our financial advice service so they can provide that personalised service for you. So I do like to start with the goal of our superannuation savings, the goal in retirement, and that is to have our comfortable retirement. Now, when I am travelling around Queensland talking to members like yourselves, one of the first questions members ask me is, how much do I need to retire? How much is enough? And at the end of the day, I wish I could give you a straight answer, but at the end of the day, it really comes down to your personal circumstance, what you're going to be doing in retirement, and how much that potentially might cost. So it's worth having a think about in your retirement, are you going to be doing things like travelling potentially? There are some great images on your screen now from some of our members that have been taking up travelling in the previous years. Obviously, we've been stuck in Australia for the last 2 years, but travelling might form part of your retirement goals and plans. Or potentially it might be more about staying home, renovating your house, potentially you're moving to a sea change or a tree change, or potentially staying home and helping your children with your grandchildren. So there's lots of different types of retirement styles, and that's why there's really no set answer to that question. It comes down to your personal circumstance and understanding what type of lifestyle you would like to be living in retirement. But lucky for us, we have some friends at ASFA who has given us some great figures that we can use to work towards. These obviously aren't specific to us personally, but what they do is they survey retirees once per quarter to see how much they're spending in retirement. And we use those figures to guide us. Now, ASFA considers a comfortable lifestyle as being able to afford things like your private health insurance, your updated white goods, being able to go on some domestic and international travel, being able to do the hobbies that you enjoy, be able to go out to dinner with friends and family once a week, and being able to run the things like the dishwasher and the air conditioning whenever we need. And obviously in Queensland, we need that air conditioning. So that's what ASFA considers a comfortable lifestyle, to build that in together. And here are the figures on the screen now of what they consider to be a comfortable lifestyle. Now, these figures are for people that own their own home and are retiring at the age around 67. So if you were retiring earlier, you would need to take that into consideration and increase these figures for that situation. As it says, for a single person who wants to retire around the age of 67 and have that comfortable lifestyle, they would be needing about $44,818 per year tax-free to have that lifestyle. For a couple, it's about just over $63,000 tax-free as well, combined together to have that type of comfortable lifestyle. Now, these figures do get updated regularly from the ASFA website. I definitely recommend jumping online and having a look at that website to keep track of that. The easiest way to get there is just by Googling ASFA, ASFA, retirement standards, and there's a great website of lots of really good information. But when it comes down to how much we actually need as a starting balance in our superannuation, we at the fund here have calculated some figures here that you can see on your screen. Now, we've broken these figures up into full age pension support, meaning people that will be eligible for a full age pension, and also people that are fully self-funded. Now, most of our members do sit somewhere in between that, and it's a big sliding scale. So for the sake of these figures, we've had to go from one extreme to the other, fully self-funded or full age pension. Now, these figures are again saying that people are retiring at the age of 67 and they're needing this money to last them for at least the next 20 years. So as you can see on the screen, if we're getting a full age pension, a single person would need about $354,000 as a starting balance. A couple, about $455,000 combined together. If you're going to be fully self-funded, so meaning you're not going to get any age pension from the government, for a single, about $685,000, and for a couple, about $951,000. So quite a big difference there, and you can see where the age pension can really supplement our income in retirement as well. Now, we'll just stop here and remind us all tonight, as Kate has already mentioned, if you do have any questions as we go along this evening, please pop them in the blue question box at the top of your screen. We love hearing your questions, and we really are looking forward to answering them at the end of our presentation this evening. So please pop them in as we go along. So we have had a little bit of a chat around the goal, and now we want to know a little bit more about how do we get to that goal? How do we get from A to B? Now, when it comes to superannuation, there are two big drivers of building wealth and two big drivers to grow our superannuation balance. And that is, one, our contributions, how much we're putting into our superannuation, and two, our investments, how we're investing that money and making sure we're in the right investment option that's working for us in the best way it can be. So to start us off tonight, I'm going to hand over to Fiona Mann, my colleague, who's going to talk more about the investments, give us a bit of an investment update and also a budget update this evening. Thanks, Fiona.
Thank you, Kelly. I just wanted to start off by saying appreciate everybody's time tonight. Working for the super fund in investments is a job that we take very seriously, and especially given the impact that we can have on retirements for our members. So what I wanted to do tonight was talk a little bit about the budget, give you a bit of an update on what the recent budget outcomes were, and then also give you a little bit of a view on how we think about investments and markets and an economic outlook for your investments going forward. So firstly, the budget was really a bit of a hot chocolate budget is what we're calling it, because everyone was a winner. Everyone across the board gained, whether financially through reduced tax or direct subsidies. The other thing that's happened in the budget, which was exceptionally important, was the fuel excise cut. Now, that's important for members. Obviously, filling your car up can be very expensive these days, but also for the inflation rate, and we'll talk a little bit about that going forward. One of the concerns about the fuel excise is that depending on what oil prices do, it could have a big impact coming off in 6 months' time, and we'll cover that off a little bit. We also saw an extension of the low and middle income tax offset, which gives people about $420 extra a year in that category, and also a one-off cost of living payment to a large number of the population, including students, concession card holders, veterans, aged care. Lots of individuals will receive that $250 payment. So just to look a little bit at actually what was in the budget, if you have a look at the chart on the right-hand side of the screen, you can see the red bars. Now, the red bars are the future of the budget surplus or deficit, and the black bar that is the one next to the word COVID actually tells us what the budget was last year. So you can see there's been a significant improvement in the budget. Largely that was actually driven by the economic growth. And the government is relying on economic growth to continue that red line to go up. As you can see, over the next sort of 10 years, we can see that line reducing significantly towards being in a surplus. One of the reasons that there is growth in the economy at the moment is commodity prices are increasing. The unemployment rate is also forecast to remain low, forecast at 3.75%, which is actually the lowest it's been in a number of decades. The question that we have in the team and at the fund is this going to put pressure on inflation? And also what happens to interest rates in that case? One thing that we will point out, and call me cynical, is that this budget was definitely one that was close to an election. So if we talk about investment outlook, I want to have a little bit of a discussion about where we've come from, where we were before COVID and where we're looking to go, and also talk a little bit about what it has implication-wise for the investment markets. So this is a chart that talks about timing versus time in the market. And I'm sure any of you who have been involved with the super fund and seen webinars before will have seen something similar. What this chart suggests is that if you put $10,000 in the accumulation product at LGIA Super back in 2009 and hadn't moved it at all, you would be 162% better off with about $27,000 in the account, despite market fluctuations. So this is about leaving money in the market as opposed to timing markets. We're going to talk about a few mega trends. I've got 4 of them up on the screen. First one is this inflation rate. Now, the inflation rate, as you can see from both the blue line and the red line, which is the red line is the United States, the blue line is Australia, you can see that it has been fairly stable over the last 40 or so years. You could probably even say 50 years. What I wanted to point out was that line right at the very end in March 2020. That line, which actually refers to more recent periods, has extended up quite significantly. The second mega trend I wanted to talk about was the relationship between share valuations and interest rates. The chart shows interest rates in the red line and the share market in the blue line. Now we can see there's an inverse relationship, quite a strong one, since about 1960s. Now the question that the markets are asking is this going to continue? And we can discuss this a little bit down the track. 70 years of globalisation. Globalisation is the third mega trend we're going to discuss. You can see from this line and these charts that the volume of exports as a percentage of GDP has increased quite significantly, especially towards the end of the chart. Now you can see the COVID impact when exports fell right at the very end, but a lot of the increase at the end is due to China, which brings me to my final mega trend. Now, China is growing as an economy. We believe that in about 6 or 7 years, China will actually be larger than the US as an economy. So one of the things that actually tells us that is very, very highly likely is you have a look at the GDP per capita chart on the other side of the page. You can see from the blue lines, that's GDP per capita for the US. The yellow line is GDP per capita for China. And you can see that just needs to increase 10% to have a significant impact on the chart on the other side of the page. So where did that lead to us pre-COVID? Pre-COVID, we saw declining real interest rates and inflation. We saw concerns about secular stagnation, and we also saw rich valuations on most asset markets. So basically the markets were just kind of plodding along. Nothing special or exciting was happening. We also saw increased inequality, both within countries and between countries, and also slowdowns and stalling in globalisation. And there was an emerging climate change response, which, as you will all realise, has accelerated significantly. So what happened in COVID? Lockdowns. Who would have believed we'd see people fighting over toilet paper in supermarkets? I certainly wouldn't. And interest rates down to zero. We had countries actually paying people to take long-term bonds on their debt. There was huge government budget deficits. Australia does seem to have a large deficit, but as a percentage of GDP, it actually isn't that high compared to a lot of the other countries. Demand for goods increased, and the JobKeeper was an incredible piece of policy that I believe has held up and saved the Australian economy after COVID. I've got a few charts here that are very interesting. This first chart, just quickly, if we have a look at the top in the green box, that's the level of deposits that actually went into people's pockets. If we go to the next chart, it'll talk about demand and what people did with that. Now, this isn't going to surprise anyone on the webinar. That services, which is the line at the bottom, the black line that's at the 100 level mark, services did not increase. They fell during COVID, and this is things like restaurants, haircuts, beauty salons, cruises, travel. They all declined because of COVID. But what is incredible and what was not expected by markets or retailers was that the line at the top, which says goods value and volumes, they actually increased significantly. And that was an incredible demand push from a lot of the stimulus that came through the economy. And that's things like Netflix streaming products. Everyone was doing lots of online shopping, fixing up their house, going to Bunnings. All of those sort of things contributed to that. Inflation moved higher. So we've seen the US is at 7.9%. That's incredible for the US, and it's way off the long-term trend. Spain recently reported about 9.2%. Australia is higher than it normally is. One of the questions that we have is, how long is this inflation going to stay around? Is it structural inflation? Is it just transitory? This has also spilt over into commodity markets too. Now, I haven't yet mentioned one of the main drivers of things recently in the economy, which is the geopolitical risk, and that has contributed to a lot of this in the commodity market. Obviously, oil prices have increased, gas prices have increased on the back of a lot of fear of supply coming out of Russia. Wheat and grain prices have increased due to the same reasons. Ukraine is a large supplier of grains to the whole world, and nickel as well is impacted by this. So one of the questions that we have around interest rates is, if we're concerned about supply issues in these markets, if we increase interest rates, are we going to get supply on faster than we would have before? Unemployment rates are also close to 50-year lows, as we've spoken about. Now, the Federal Reserve is a little bit behind the curve in increasing rates. So you can see from this chart, look at the trend over time, and you can actually see that the red line shows that you have got higher levels of inflation versus where high levels of inflation compared to interest rates. So there's a little bit of catching up to do. The problem is, if they catch up, what's going to happen to demand and growth in the economy? They don't want to go too quickly. They don't want to go too slowly. It's a little bit of a catch-22. So are markets expensive? The chart with the forward price earnings is essentially the expensiveness of a market, so to speak. The top red line is the US, And the blue line, the light blue line is Australia. Now, you can see markets coming down a little bit, but if you go to the other side of the screen, you can look at where earnings per share are. Now, earnings per share actually tell us almost a barometer of where we expect prices to go for stocks. Now, you can see they're still going up. So you can see we've got inflation going up. We've got interest rates that are reasonably low. We need to slow the economy down. But if we do it too quickly, we could cause more trouble than we're trying to actually fix. So what happens is we think about, are we back to normal or a new normal? And this is a question that we pontificate and economists write lots of papers on and we think about as a team because it has a big impact on how we position portfolios from an asset allocation point of view. So this screen here talks about the fact that when we have a crisis or we have something unexpected happen in markets, like the Russian crisis at the moment, or we've had the global financial crisis, there's been plenty of them over the years, markets typically factor things in, they fall and they forget and they forge ahead. And I think we're in a little bit of a period where it's climbing close to forgetting and moving on. We have seen a bit of volatility in markets over the last 3 months, and we have seen them come back a bit. So you can see those numbers. The initial impact, they're down 12%. After 3 months, they've forgotten about things. They're up 11% and moving on. And that chart on the other side of the page is probably one of my favourite charts. It actually tells us, it's from Apple. It talks about the mobility data. So what that means is people being out and about and around the place. So you can see before COVID, it was up around about 120 for Australia, and Sydney is the black line. And you can see now the recent data, it's 121. It's actually back to where we were. So we're out and about just as much. So things are pretty much back to normal. So what these conclusions are, series of negative supply shocks plus positive demand growth. We've had government stimulus. We've had central banks being behind rate increases. See what happened today? The central bank held rates steady. We've had inflation higher, and we're uncertain what is the real level of inflation and how long it's going to stay and whether it's going to go up or down. The dollar will remain high, driven by commodity prices, which is good for exports, good for our economy. And Russia's invasion of Ukraine stirs the pot, but I don't think it's going to stop markets from doing what markets are going to do. We have no more cheap money and low inflation, which is what we've had for a while. It was like a perfect storm for investors. Returns are going to be lower across most asset classes. That's something that, has come out of this. We've had incredible returns in markets, especially equity markets, over the last few years. So what that tells us as a fund is it's really important to have a diversified portfolio, and active management is critical, which means choosing the best managers, the best investments, and the best things that are going to help you get to those levels you need to have when you finally retire. So I'm going to once again remind you that we have question box. So if you have any questions, please put them in the box and we can discuss it after. I'm going to hand back to Kelly.
Perfect. Thank you, Fiona. So as we just heard from Fiona, there are obviously a lot of moving pieces and considerations when navigating long-term portfolio through many different times, but even times of instability. As Fiona mentioned, obviously diversification is key. Now, here at the fund, we offer our members 13 different investment options across diversified portfolios, single asset classes, and socially responsible options. But for most of our members, they do tend to invest in a diversified portfolio. Our default investment option is a diversified portfolio, as it provides the ability to be able to spread your risk over multiple different assets. So for those of you who don't know, a diversified portfolio is a portfolio of different types of investments, meaning that if one of those investments potentially isn't performing so well, there is money in other types of investments that might be able to prop that up a little bit to get through those times. We offer different types of investment options, from lower risk diversified portfolios to higher risk diversified portfolios. And for those of you who have never made a choice before, you would be in our My Super option. And you can see My Super sitting there somewhere in between the medium to high risk option. Typically speaking, our My Super option is built for someone that might have a 5 to 7 year time frame. But it's not the only option you have. There are different options available to you through the diversified portfolios from the lower risk to the higher risk, and you can see them there across both the LGI super products and the energy super products as well. So when it comes to understanding which investment option is best for you, there are two things that most members do tend to consider. One of those things, generally speaking, is our time frame, so how long we look to intend to leave our money in superannuation. And the second one tends to be how we feel towards risk, or how much volatility we're willing to take on board to get the type of return that we want. Generally speaking, the higher risk options tend to perform well over a long period of time, but in the short term, they fluctuate more. On the flip side of that, the lower risk options tend to perform not as well over a long period of time. They're lower performing, but in the short term, they actually don't fluctuate, or generally don't fluctuate as much. So it is something that we need to consider our time frame. I do want to focus a little bit on time frame, and I'm going to do that over two little different slides. So we do have another graph here for you all. So this graph is showing a very short period of time. This is actually from July 2011 till about December 2012. And the reason I picked this period of time is because we can see here in that short period of time, it looks like predominantly, and I'll just relate the lines, we've got the pink line there, which is cash, which is relatively straight. The green line there, which is the My Super option, which is the default option across the funds, and the red line there, which is the aggressive option. So when we look at that screen, we can see that, yeah, My Super and aggressive, they do fluctuate a lot. And in this very short period of time, they are fluctuating under that cash line. But if we take a look at that graph, now that's that very short period of time there at the arrow. If we look at that graph for the next 10 years, we can actually see that both the aggressive and the My Super option have outperformed the cash option and have been able to give you that strong return over a long period of time. Now, obviously, past performance isn't always a reliable indicator of future performance, but what it does do is it shows us a little bit about how these options may behave and what their behaviour is built to do. We can also see here that both the My Super option and the aggressive option, they do fluctuate. They do fluctuate ongoing, and there's lots of fluctuations in there. So if someone was to take on an option like My Super or aggressive, they would also need to feel comfortable with the fact that there are going to be fluctuations over that longer period of time. But typically speaking, if someone's got that longer period of time to invest those funds, they may look at something like a higher risk option, because potentially there is ability for potential higher growth. So where do we go from here? Well, as I said, understanding your time frame and understanding your risk tolerance are two biggest key takeaways from understanding where you might want to invest your funds. However, we do have financial advisors here at the fund that can give you personal financial recommendations over the phone at no additional charge. This is actually something that's built into your membership, and they can tell you which investment option is best for you moving forward. So if you are a little unsure or would like to get that peace of mind knowing you've spoken to a financial advisor and they've told you what's best for you, then I highly recommend booking into our financial advice service. And I'll come back to how we do that later on this presentation. I also just want to mention here, I've got an image on the screen here. A lot of people think about their time frame as between work and retirement. That's my time frame I have to invest. And yes, that's a very important time frame, but I want members to think about also the time frame that they have from retirement to the time either that money runs out or they pass away. That's another really important time frame, because if we're intending on using our superannuation as an income in retirement, our money still continues to be invested, and we still need to make sure we're making the correct investment choice for that time period. So just keep that in the back of your mind, because that will be something that you'll need to discuss with a financial advisor when it comes time for your retirement as well. So now we're going to talk a little bit more about how we build our retirement nest egg, how we build our retirement savings. And typically we do this through our contributions and understanding the best ways that we can add contributions into the fund. Now, whilst we're working, we're generally, hopefully, getting a salary, and that salary is usually divvied up to lots of different buckets in our life. First of all, we do all have to pay a little bit of tax, or maybe a lot of tax, depending on who you are. And we are going to talk about some strategies that you may be able to use to potentially reduce the amount of tax you might be paying. We also need to pay for our fixed spendings, obviously, our mortgages, car loans, rent, food, all the types of stuff that keeps our life ticking. We need to make sure we're having a little bit of fun, so we need to put some money in the fun bucket and enjoy our life. And lastly, we need to make sure we're putting some savings away for our future. So this is where our superannuation savings would really go, into our future bucket. And making sure, if you have the ability to take some funds from your salary potentially and moving that into your future savings, whether that's future savings for potentially you're saving a house deposit to buy a house, or future savings for retirement savings, depending on where you are in your life stage. Now, when we talk about superannuation and tax, there's a really great rule that a lot of members don't necessarily always understand, but it's something that they're really happy about when you do explain it to them. And that's the idea that superannuation has generally speaking, a lower tax rate than a person's personal marginal tax rate. And I'll just explain that now. If we earn between around $45,000 and $120,000 per year, everything that we earn gets taxed at our personal marginal tax rate. And if we earn between those brackets, it's about 34.5%, including the Medicare levy. Any money that gets paid into superannuation, either from our employer or as a salary sacrifice contribution, gets taxed at a lower rate of 15%. This is called a super tax rate. And essentially the government has made this as an incentive for us to save for our own retirement. Obviously less people on the age pension and less money they may have to pay out for the age pension. So it's a really great tool to be able to save money for your retirement at the same time as saving a little bit of money on tax. This is from a dollar value, this is what it might look like. So let's say, for example, someone was wanting to add an extra $5,000 per year into their super. This could be an extra payment that they're making, or it could even be a mandatory payment that they might have to make, particularly if you're working at a council, for example, there's some mandatory payments there. If you were to make this payment as an after-tax contribution, you're paying about $1,700 in tax on that money. If we were to go ahead and salary sacrifice that same payment, we're now only paying $750 in tax, saving us $975. That's a great saving, and some people might even look to re-contribute that tax saving back into their superannuation to help boost their savings, or they might put it back in their pocket. Obviously, it's depending on your life stage and what you're needing and wanting to do, but that's less money going to the ATO, and I'm sure that's something that most people would be pretty happy about. This is a great example of a member that's done this over a long period of time. So this is Wyatt. He's age 55 and has about $200,000 in his balance. Wyatt decided at age 55, every year between 55 and 60, he was going to add this $5,000 into his super. Now, if he did this as an after-tax contribution, he'd end up with nearly $278,000 in his superannuation fund. But he actually decided to salary sacrifice that $5,000 and recontribute the tax savings back into his super. By doing that, he got an extra $21,200 into his super in that same time period, and he saved himself $5,000 on tax, recontributing that back into his super, and that's money that otherwise would have gone to the ATO. So again, another good, happy story for a member who's been able to help boost their balance and save themselves a little bit of money in tax at the same time. Now, like all great things, there are rules and limits around this, so we need to make sure that we're conscious of that limit. That limit currently is $27,500 per year, and that does include everything that your employer pays, plus anything that you salary sacrifice, plus anything you may claim as a tax deduction. So just be mindful of that cap if you were thinking about adding extra contributions into your super or salary sacrificing contributions into your super. However, there was a bit of a rule change back in the 1920 financial year, and this rule change meant that anyone who had a superannuation balance below $500,000 was able to use what we call a carry forward rule. And this is where in your cap, if you didn't use a certain amount of that cap, so let's say, for example, in the 2019-2020 year, the cap was $25,000. If someone only used $10,000 of that cap, $15,000 of that cap rolled into the next financial year to be able to be used. On top of the $25,000 in that year, gave them $40,000 to use in that year. And that's going to be working on a 5-year rolling scale. And that's something that you may be able to use to try again to boost your superannuation balance and again, save yourself a little bit of money on tax. Now, this is something that you might not be able to use right away. Potentially you don't have the funds to be able to redirect into superannuation. Maybe you've got things like mortgages and children that you need to pay for that's a little bit more pressing. But because these contributions are rolling forward a 5-year rolling cycle, you would potentially be able to use them in those later years in the lead up to retirement, where potentially mortgages are paid off or even children are no longer needing to be paid for, fingers crossed. There are obviously other ways that we can contribute money into our superannuation as well. So any money that does come into super after tax also has a limit. That limit is $110,000 per year or $330,000 using what's called a bring forward rule. We also have a rule around downsizing. So if you are selling your primary place of residence that you've owned for at least 10 years, you can put the proceeds of that sale into your superannuation fund, up to $300,000 for yourself, $300,000 each if you are in a couple into your own superannuation accounts. Currently, you have to be over the age of 65 to do this, but as of the 1st of July this year, that has dropped down to age 60. So one great way of trying to add some more money into super without having to be underneath the caps. Now, transition to retirement accounts are a way that people can use different strategies to help themselves with different things in the lead up to retirement. This could be tax saving strategies plus another couple, but essentially transition to retirement accounts allow us to access superannuation whilst we're still working for these different strategies. So one, as I mentioned, may be being able to add additional contributions into your superannuation account and claim a tax deduction on that, reducing your taxable income potentially and saving yourself a little bit of money on tax. There may be the ability to work less and therefore obviously your income's going to drop down if you work less, but you could use money from your superannuation to supplement that loss of income. You could use a transition to retirement account for debt repayment in the lead up to retirement, or you could use it for estate planning purposes. So transition to retirement accounts have lots of different ways that people can use them. They can be quite tricky, and we highly recommend reaching out to a financial advisor if you are thinking about using them. Essentially, the way they work, just a brief overview here, is it allows us to move money from our accumulation account into a transition to retirement account. And this account allows us to draw a maximum of 10% of our account balance per year from that account. Now, we do have to meet our preservation age to be eligible to set up one of these accounts. Typically speaking, for most people watching tonight, your preservation age would be 60. However, for some of you, it will be either 59 or 58 as well. So just be mindful of that and reach out to us if you need to confirm your preservation age. If you are over the age of 60, these payments coming out will be tax-free. If you're under the age of 60, there will be tax involved. So it is a way that you can take funds out and then use them for one of those many strategies we briefly outlined before. So as I said, I'm definitely not going into great detail around this strategy, but if it's something that piques your interest, absolutely reach out to us, get in touch with a financial advisor so they can see if this is an option that you can use to boost your super or get you on the way to retirement. Now, we are going to talk a little bit more about income in retirement now. So we've stopped working, we've retired, and we're now come to the point where we're asking ourselves, I haven't got money from my work anymore. Where is my money going to come from? Typically speaking, there's usually 3 places, and you might have heard of the 3 pillars of retirement. First one they talk about is compulsory superannuation payments. Second one they talk about is additional payments or savings, and this could be inside or outside of super, like other assets, investment properties, share portfolios, etc. And the third pillar being the age pension. So we're going to talk about the super and the age pension side of things tonight. So first of all, super in retirement. Now, generally speaking, most of our members in retirement might look to set up a pension income stream account with us, and they might do that for a couple of different reasons. One, an income stream pension allows someone to draw a regular income from their super, much like we get a regular income from our employer. It's a nice, easy switch, and when we've spent 30 or 40 years getting a regular income every fortnight, it's really nice to be able to continue that, but rather than getting the income from our employer, we're now getting the income from our superannuation. The other benefit is we don't have to pay tax on our investment earnings in super. So we're leaving our money in the superannuation system. We're allowing that money to be invested within superannuation, and we don't have to pay tax on the earnings. Unlike our accumulation accounts where we have our money going into at the moment, those earnings do get taxed at 15%. So in positive years, a pension account will have a higher earning rate than an accumulation account because of that tax difference. As I said before, if you're over the age of 60, all payments out of your pension account are tax-free. The only consideration with the pension account is you do have to draw a minimum per year. So generally speaking, as long as members are happy to draw that minimum payment, they would more likely look to set up an income stream pension account to be able to have that regular income through their retirement and ongoing as well. When it comes to the age pension, however, there is a lot more rules. Obviously, the age pension is governed by the government. There's lots of legislation and Centrelink. But essentially, the way that the age pension works is, first of all, you need to meet your age pension age, which for most of us will be age 67. And secondly, they test you on two things, your assets and your income. And whichever test gives you the least amount of pension is actually what you're entitled to. Now, on the screen in front of us here, what I'm providing is the upper cut-off threshold limit for the income test. What this means is if your income is above what you can see on the screen there for a couple or a single, you would not be eligible at this point in time, based on the current rates, for any age pension from the government. If your income was below this figure, you potentially would be eligible for a part pension. So for a single, we've got $2,155 per fortnight they can earn up to before the pension cuts off to nil. And for a couple, about $3,297 per fortnight. Same sort of setup with the asset test. So just as a background, assets is essentially everything that you own minus your primary place of residence. So if your primary place of residence, it doesn't matter how much it is not included as an asset in the assets test. Everything else is. So superannuation is usually the next biggest one and very important. Money in the bank, share portfolios, investment properties, cars, boats, caravans, motorhomes, contents of your home, all of that is considered an asset for this asset test. So at the moment, what this page is saying is and this is based on homeowners as well. So if you don't own your own home, there is a separate figure that you can get on the Services Australia website. But this is saying if you have less than, as a single homeowner, $599,750 in assets, you may be eligible for a part pension. And for a couple homeowner, $901,500 combined. Underneath that, you may be eligible for a part pension. Rounding up the pension account now, these are the full age pension figures. So if you are eligible for a full age pension, you'll be getting, as a single person, $987 per fortnight. As a couple, it's combined at $1,488 per fortnight. If you are not eligible for a full pension, it'll be something between the figure you see on the screen and $1 before it cuts out to nil. So that's what they consider a part pension. It's a very big sliding scale, and that's why it is best to either reach out to a financial advisor here at the fund who can give some personal advice around Centrelink entitlements, age pension entitlements as part of our retirement planning structure, or potentially you can reach out to Centrelink. So this slide here is showing us when we combine our age pension entitlements and our superannuation together to give us our comfortable retirement, our comfortable lifestyle in retirement. So we've got the first asset test value here, and that's saying at an asset test value of about $270,500, both a couple and a single person would get a full age pension, and then they would use money from their superannuation to give them the rest of the income they need, combining them to provide themselves with the comfortable retirement lifestyle that they need. Obviously, the more money we have in our assets, if we're on the asset test, the less money we get from the age pension and the more money we need to draw from our superannuation. Now, realistically, when it comes to real life and using our super and our pension, what typically tends to happen is when we start our retirement, we have obviously our largest amount of superannuation. Typically, sometimes it can grow as we're drawing out when we've got some really good strong returns. But typically we find that over time our superannuation balance is slowly decreasing as we're taking money out of our superannuation to live on. And as that slowly decreases, that then may mean that you may be eligible for more age pension as years go on. So typically speaking, they're balancing each other out to give you that comfortable retirement that you may need to have or that you're working towards. Now, I've said all night, reach out to get some personal financial advice. This is the page where you would go ahead and get our contact details. So both LGIA super members and Energy super members do have access to both our limited advice service and our comprehensive advice service. So to explain the difference, limited advice just means that we are able to give personal financial advice over the phone at no additional charge. It's built into your membership, and it's around 3 particular topics: contributions, investments, and insurance. If you are looking for comprehensive advice, so this is where a financial advisor is going to look at your full personal situation. They're going to give you retirement planning advice. It's going to bring in estate planning, potentially non-superannuation wealth strategies outside of super. So they might bring in other assets that you have outside of super as well, and provide a full financial plan that is available to you at the fund. It is a fee for service structure, but they do offer an initial consultation at no charge. So you can sit down with them, talk about what you're wanting to do, and they'll be able to talk to you about what they can provide and the strategies that they might be thinking for you. Definitely reach out to us either by email or phone so we can talk more about those different options, so we can get advisors to you. So, you've got peace of mind, you've spoken to an advisor, and you've got a plan for retirement. I'm now going to pass back to Kate, who's going to ask some of our great questions you've been passing through. Kate.
Fantastic, and thank you so much to both of you for what's been a really interesting and informative evening. I hope that you've enjoyed it as much as I have. So we've got some great questions here, actually, and I'm going to start off with a question for you, Fiona, and this comes from Alan. What exactly is diversified fixed interest, and what is causing it to go backwards at present?
Thank you, Kate. Good evening, Alan. That's a fantastic question. And the diversified fixed interest portfolio is made up primarily of bonds, and with interest rates increasing, the bond values are decreasing, and that portfolio, that is the main reason why that portfolio has underperformed. It is generally considered a lower risk portfolio over time, and at the moment when we have interest rates at such low, at levels where they're starting to increase, we're seeing that happen to that portfolio. But it's a great question.
Thanks very much, Fiona. So I've got one for you now, Kelly. And this one comes from Paul. Is the super balance included in the pension assets test?
Yes. Hi, Paul. Yes, the superannuation balance is included in the assets test. So the assets test is every single thing that we have, not including the home that we own. So yes, superannuation is included.
Thanks very much. One for you, Fiona. What is secular stagnation? You talked about it.
I did talk about that, and I apologise I didn't explain it. So secular stagnation is essentially when we're talking about not a lot happening growth-wise across the world, basically. So GDP growth sits at around 2 or 3%. Not a lot is going on in the economies around the world. That's a great question.
Thanks very much from that, Fiona. So another one for you, Kelly. This one comes from Brian. Thanks for the information, especially the amount required to retire. So his question, when it comes to retire, how does he get his money? Is it a lump sum, a pension, weekly income, any other options? Just conversation on that one.
Yeah, great question. There are definitely a couple of different options, and tonight we really only touched on one, which is a pension income stream, and that's just typically because it is one of the more popular options. But you also have the ability on taking a lump sum payment. So whether that's going to be the full superannuation balance, you are eligible to take that as a full lump sum, or you can leave your funds in an accumulation account and take lump sums when you need it. The benefit of leaving it in an accumulation account is you don't have a requirement to draw down a minimum payment like you do in a pension account, as we said earlier tonight. So if you didn't need money for a long period of time, potentially you're living on other assets, you can leave your funds in superannuation, leave it in the accumulation account, not have to draw any payments, and potentially take lump sums when you need it. Pension income streams, as I mentioned, you do get a regular income, and there is a minimum requirement to draw a minimum payment per year.
Fantastic. Thank you so much, Kelly. Another one for you, please, Fiona, and this one I know will be very close to your heart. Does the diversified portfolio include socially responsible investments?
Yes. So that is very close to my heart. So thank you to the member that asked that question. My other side of the role is head of ESG, and it's something that we do take very seriously at the fund. So all options, all portfolios at the fund have ESG integration through them. We haven't, and I suppose the best way to explain it is that we don't, in the overall portfolios, we don't exclude specifically. What we do is we integrate it in a manner that does not impact on members' risk and performance. That's one of our core ESG philosophies. If members are interested in products that do exclude, we do have SRI products where specifically they have exclusions through the portfolios.
Thanks very much. Another one for you, please, Kelly. And this one comes from Paula. I'm an LGI super member, but my husband works for a private company that provides super through another fund, and we're not happy with the performance of that fund. Given current world events, is there such a thing as a good or bad time to switch to a new superannuation fund or change investment options within my fund?
Yeah, great question, Paula. And it's definitely a big consideration there when you're thinking about when to do that. As Fiona said earlier, it's really hard to time the market. So it's probably not something that, I don't know, it's something to really have a think about. Realistically, it depends on your time frame. So I guess you think about it this way. If you wanted to change your investments or your husband wanted to go ahead and potentially become an LGI Super Energy Super member, which we'd love to have him on board, then realistically, if you're going to do that now and, you know, there was a change to the investment return or potentially because of markets it was fluctuating, will that fluctuation create a dramatic difference over the next 10 years, 20 years or 30 years that you're investing? The answer is probably not too much. But at the end of the day, that's something that you'll need to consider. Typically speaking, you know, members chop and change superannuation accounts all the time. And it's really about understanding if you're not happy with the performance of that fund and potentially the fees of that fund, then taking that into consideration as well and moving away from that fund as quickly as you want to.
Thanks very much, Kelly. I'm going to answer the next question, which is exciting for me, I have to say. So this one comes from Peter. Are you looking at introducing longevity products such as annuities? So at this point, we aren't, Peter. Thanks for asking the question. We will be putting a strategy up on our website from the 1st of July, which talks about how we're going to ensure that we deliver, you know, the best possible retirement incomes for each of our important cohorts of members that we have within the fund. The work that we've done to date would suggest that the products that we have within our suite are able to be sort of mixed and matched to give great outcomes for after retirement for most cohorts. So at this stage, we probably won't be looking at longevity products, which actually haven't been that popular in the market. Thanks for the question. So another one for you, please, Kelly. This one comes from Terry. I'm 73, retired, and want to contribute $200,000 to my super fund. Is that allowed?
Yeah, great question, Terry. So at this point in time, no, unless you are working and you just tell me you're retired. So no, at this point in time, you wouldn't be able to add additional contributions into your superannuation. However, there is a rule change that's happening from 1 July 2022, where that is being increased to age, I believe it's 75. So definitely reach out to us and just get us to clarify that. And we'll be able to help you put those contributions into superannuation once we're in the new financial year.
Fantastic. Question from Christos here. Is there any talk about increasing the super limit for the lower tax rate, the 15% obviously, or the pension tax rate of 1.6 million? Well, I can say that that has gone up to 1.7 million. So that's very good to hear. Another question for you, please, Kelly. What is the minimum drawdown from a super pension account?
Yeah, so the minimum drawdown generally is dependent on your age. So if you're between the age of 60 and 65, it's 4%. Between 65 and 74, it goes up to 5%, and it continues to rise as we get older. At the moment, though, the government has allowed us to cut that in half, and it's just been extended for the next financial year as well. So if you're between the age of 60 and 65, you're normally 4%. It would now be continuing at 2%, 2.5% for the next bracket, and then halving as it goes up as well.
Thanks very much. Quite a few more for you, so just strap yourself in. So if you take, this one comes from Helen, if you take lump sums instead of an income stream, do you pay tax on the lump sum withdrawals? Many thanks.
Yeah, another good question, Helen. So tax is all about your age and when you take it. So the magical number in superannuation is 60. If we can wait until 60 before accessing any of our super, it'll always be tax-free, regardless of whether it's a lump sum or it's coming from an income stream. If you're taking money from your superannuation before 60, if it's coming as a lump sum, there is a cap. I believe it's about $210,000 at the moment, or maybe a bit higher. That is tax-free. After that is taxed at 17%, but that's under the age of 60. Over the age of 60 is tax-free.
Thanks very much, Kelly. This one from Amanda. If I was to sell an investment property, would I be able to place that into superannuation tax-free?
So yeah, Amanda, if you do sell an investment property, it will depend on how much you're wanting to put in and obviously your age as well, because there are, as we heard before, limits on ages depending on when you're intending on putting that money into super. So it would just have the same rules as the contribution caps. If you were putting it in as an after-tax contribution, which means it won't get taxed when it comes to the fund, it's $110,000 per year that you can put in, or up to $330,000 in one financial year, which just means for the next 2 financial years, you would not be able to put in any more after-tax contributions into your superannuation fund.
Thanks, Kelly. Just got one in for you, Fiona. So what's been the impact of the recent real estate market on super? That one from Colleen.
Thanks for that, Colleen. That's a good question. We've seen the recent real estate market rising significantly. So what that has done is it has basically put pressure on people who are trying to get into homes, because now it's getting incredibly expensive. And I think that going forward, what we're going to see is with interest rates rising, we are going to see some people who may have committed to mortgages that are actually too expensive. It's very different to have a mortgage at 1% interest rate as opposed to 2 or 3 or 4%. So I think that what we have seen in markets recently has been driven by not only COVID, as we talked about the demand, where people are actually spending more money on their homes, they're not travelling, they're changing homes, they're moving more frequently, but also I think the low interest rates, it kind of created a perfect storm for a housing market boom. But I think going forward, we are going to see that start to slow down a lot.
Thanks very much, Fiona. One for you, Kelly. This one from Jenny. What's the easiest way to find out how much in total you've contributed through salary sacrifice before the end of the financial year?
Yeah, great question, Jenny. The easiest way for both LGI Super and Energy Super members is through your member online account. At the moment, they're 2 different systems that we're using, but both of those systems allow us to get your salary sacrifice contributions or full concessional contributions if you wanted to as well for the financial year. So you can see where you're up to in that limit. If you don't have access to your member online account, or you would prefer not to jump onto the internet, always welcome to give us a call in the contact centre and we can tell you those figures over the phone as well.
Thanks very much, Kelly. Another one for you, Fiona. What is LGI Super's approach to cryptocurrency investments?
So LGI Super, we do not invest in cryptocurrency itself. However, the technology behind it, the blockchain technology, is something that we look at, and it is an emerging possibility to be part of investments in other companies as opposed to the cryptocurrency itself.
Thanks very much, Fiona. Another one for you, please, Kelly. If I start a pension account and take an income stream, can I also take a lump sum from time to time?
Yeah, another great question. I didn't mention that earlier, but yes, you can. So once you set up an income stream, you have full access to that funds. So you've got your regular income, but you can also take lump sums if and when you need for things like, holidays or buying a new car. The superannuation, the pension account, it's not locked up for any particular time. So if you do need to take it all out as well for any particular reason, you can also do that. Yes.
Well, thank you so much. We're going to wrap it up there. That's a fantastic group of questions. And certainly if we didn't get to your question, please rest assured that we'll come back to you over the next couple of days. So before concluding, I do want to remind you that our fund is not just for those who are in local government or the energy industry, but is open to everyone. So to learn how your spouse, your friends or your broader family can join, please go to lgrsuper.com.au or energysuper.com.au, and you can also, of course, ring our contact centre and talk to our team. So that draws to a close our webinar tonight. I do hope that the presentations tonight were beneficial for you and interesting to you. I certainly found them really interesting. And that you can see that we'll continue to work hard in your best interests and making sure that you know what we're up to at every point in time. Thanks again for attending our webinar and have a fantastic evening.